And I told him, if your investments are down, here's a couple ways that you can be changing your situation. The stock market is down, yes, but there are some things that you can do today to improve your situation for tomorrow. And the key is, you can take control. You no longer have to be dependent upon the stock market. You no longer have to be dependent upon whether we're going up or down. You can make some small changes that are going to better yourself. And the thing is, these strategies work in good times and in bad times. So no matter if your investments are going down or if they're doing well, having some simple strategies in place can really help you to make sure that you can be growing your assets, that you can be having them available for the future. Buy and holding is not working, and what you are starting to see is the ramifications to that. Now, here's what I mean. When we talk about buy and hold, really what we're talking about is the fact that you are going to take your own investments, or your financial advisor is going to take investments, and we're going to go into a certain type of investment scheme. So that's usually called diversification. So whether we have some international with some US growth, whether we have some value in there, some real estate, emerging markets, some bonds, and different types of bonds, ones that produce income, whether that's tax deferred or even tax free. All of these mean something when it comes to diversification. But here's really the thing that really starts to crop up when we're in this type of an environment. You see, when we take a look at history, so let's take a look at 2000, 2001. We had the tech bubble crash. Well, that was something that we started to see a lot of different assets and a lot of the different diversification methods fail to work the way they were supposed to, and to protect your accounts the way they were supposed to. Then we take a look at 2008, 2009 with the housing crisis and the Great Recession that we had back then, and you start to see the same exact things, that what should have been a safety net wasn't, and that's why we started to see assets and investments that you were in start cratering. So whether it was real estate or stocks or even bonds at those point in times, a lot of things started to change. Well, even today, with respect to the fact that we had this COVID bubble that started to be blown up with respect to all the money that we were putting into the stock market, into the economies, we're starting to see the exact opposite start to happen. We're pulling money out of the economies now, out of the stock market, out of the bond market. And what you're really starting to see is that buy and hold strategy is not working the way that it was supposed to and the way it was designed to. Because whether we're invested into bonds or whether we're invested into stocks in the US, stocks internationally, stocks anywhere, bonds anywhere, they're actually coming down in price at the same exact time, in tandem, and in the same exact manner. And that's not what was thought of with that 60-40 portfolio that you keep hearing about. That we had bonds and we had stocks and we had maybe some real estate and some other little things scattered about there, and that would provide the diversification. That would provide the means, the ways that we could actually be safeguarding our investments. Well, since that's not working because everything is what's called correlated now, and when things get bad, all of those correlations start to really make sense and really start to go to what's called one, and that means that they move up and down in tandem with each other. And right now we're starting to see the downward movements starting to happen in tandem with each other. And what that means is the risk is creeping up. The risk that you have with your portfolio is starting to increase because we don't have those safety nets in the same way. So what do you do when things like this happen? Well, first of all, if you are doing your own investing or even your financial advisor, there are some things that you can do today in order to start making the changes, the pivots that are needed to safeguard your wealth. Because what we know, the more we go down on a percentage basis, the more we actually need to go up. So it's not going down 10% and then just going up 10%. No, because remember, when we take a look at, let's say we go down 10% from 100, well, that means we're going down to 90. But if we go up 10%, that only brings us back up to 99. So that doesn't even bring us back up to where we were. So we have to grow your investments more when they go down more. And so there are some things that you can actually be doing right now that you can be talking to your financial advisor to make those small little changes occur. So here's some of the thought processes that you can be using with your own money, with your own wealth, with your own advisors to talk about how you can still use those strategies, the diversification strategies, the buy and hold strategies, the things that you know already, but you can be adding to them in the correct ways. And it really starts coming back down to knowing what environment we're in. Now, what I call this is the LEAD index. So that's the Lions Wealth Economic Activity and Development. And there are 4 stages that we can be going through here. There's one where we have a lot of growth happening in our economy, but not a lot of inflation. Well, obviously, in this environment, we may not be in that type of stage right now. Well, then there's the second stage where we have a lot of growth happening in this environment, but we also have a lot of inflation. That is actually a very good stage to be in as well. So stages 1 and 2 are actually very good. And there's going to be great times for you to be finding good investments and diversification among those lead stages. Then we have the third one. And what happens in the third one is that we have a lot of growth with inflation, but we don't have a lot of growth with the economy. Now that's where stagnation starts to creep in, and we really start to see the hardships of that, the stagnant growth with a lot of inflation, and we can start seeing how prices are going up, but wages are not. That is not a good place to be. But then we also have that fourth and last stage, and we really start to see the fact that we have a slowing of growth and the slowing of inflation start to occur, sometimes even deflation. Well, a slowing of growth, slowing of inflation, I would start to call that disinflation. So it may not be completely deflation, but it's not necessarily a good factor. And when we are in those types of environments, things start not to work the way that we thought they would. So let me give you an example. So when we take a look at environments that we're in this lead 4 stage, we really start to see that, well, stocks are not working very well. And it depends on the length that we're in. Maybe this is just for 1 quarter, so maybe 3 months, or maybe this is a prolonged period of time where stocks are not working because of the fact that the economy is not doing well. And when the economy doesn't do well, obviously then it comes back to the companies. The companies don't do nearly as well because they're not selling as many goods. Maybe they're not selling as many final products, finished products to the consumer, or even wholesale inventory. Well, on the service side, maybe people are not going to the restaurants as much, or they're not going to amusement parks in the same way. So all of this starts to really kind of bear out because of the fact of the way in which we are working with the economy. The lead stage, as I call them. So that's something that you can figure out as well. Knowing what those stages of the economy are and where we're going for, say, the next 3 months, 6 months, will actually help you and help your financial advisor to make better decisions on which investments we need to be purchasing and holding on to. So we still want that diversification, but it just comes back down to making some small adjustments that are going to be more beneficial when the time comes in those types of environments. See, if we're in lead 1 and lead 2 where everything is working, well, then we can just have that set it and forget it type of mindset because we know that things are going to do a lot better just because of the fact of where the economies are. Now, that's not a guarantee, but on the same standpoint, having that diversification really helps in those types of environments as well to make sure that you are having growth happening in certain areas, but maybe some are not doing nearly as well. Well, that's where we can be really offsetting each other and having an overall portfolio growth happen. Now, when the bad times come, yes, we have bonds that are traditionally our safe havens. We have real estate that can be a safe haven. And there's actually a lot of other areas that can be safe havens as well. But sometimes those safe havens don't work. So in environments where we're going through what's called quantitative tightening, where the government is actually taking money out of the system, and sometimes they're actually selling more bonds so that they can either be funding the government or maybe they want to reduce the balance sheet. Well, those things really start to come out, the fact that bond prices may not be as good as what they used to be, because there's a lot more bonds, a lot more supply on the market of just bonds in general, and that means that there's not as many opportunities to grow and to protect with those bonds. So what do? We have to make some changes. And those changes really come back to those lead stages. And then there's a second element that you can be working on and talking to your advisor about as well. That's what I call the signal. And the signal is just the trends, where we have been over, let's say, the last 3 months or even the last year with, are we going up in that investment or down in that investment? Sometimes we can even be going sideways with the investments as well. But when we know the overall trends, we can start to see which direction we're going, and we can start to make some small changes. So give you an example here. If we are invested into some international, just for sake of argument, let's say it is European stocks and European countries that we can be invested into. Well, maybe they are in a different lead stage than we are. So we can be going through, say, lead 3, where we don't have a lot of growth, but we have a lot of inflation coming. But maybe some of those European countries are in lead 1, where they don't have a lot of inflation, but they have a lot of growth. See, that's the value of diversification. And then we can start saying, well, we can start putting a little more of the money to areas that are working, because we know that that lead stage is going to be actually more beneficial to growing. Now, again, that doesn't mean that they have to grow. It doesn't mean that it's going to be a guarantee. But what it does mean is the probability, the probable outcome, the mathematical probable outcome is going to be there to actually say that that's going to be more likely to grow than other areas. So we can put a little more money to that area. Now, that's calling be strategic. And we can be looking at and saying, all right, well, maybe we can be shifting money around. There's a lot of reasons to be strategic and starting to put money to where it's working. Now, that is to say that there's going to be some areas that are working better than others. And this is probably what your financial advisor is already doing. So they're already doing some of those aspects. They're taking a look at the strategic areas to be putting money aside. And maybe you're doing this as well. Well, if they're not, this obviously is cause for alarm, and obviously to have a talk with them just to say there may be some better avenues and some areas that they could be going down. But if they are, that's a good first step. Well, knowing what environment we're in, knowing what, then again, the strategic area of where to go, that's going to be a very good aspect. But there's another element to it, and this is where many financial advisors fail at, because they're not taught this. And that's where maybe you have been struggling as well, and saying, well, with that buy and hold strategy, and maybe we are being tactical, maybe we are starting to put a little bit more money towards some of those areas that are working. But how do we know if that area is going to be continuing to work, or if we need to be moving out of those? Well, that comes back to the signal. And the signal then is really based upon the strength of how well it's working. So we can actually be saying, well, yes, it's in a good part of the economy. So it's in a good lead stage. We are in a good area that's actually been growing for a little while now. But then the signal says, whoa, wait, let's not be invested in there. There are some red flags that are starting to creep up. And what you should really be knowing and understanding is that the signal beats out the strategy. The signal beats out the buy and hold philosophy. The signal is something that is really going to save you money. And that signal, like I said, the strength of that trend that we're in, that's really what comes back to saying, well, maybe we don't want to be as invested into bonds right now, especially with bonds going down in price. When bonds start going up in price, when they're actually starting to change course and the signal says, hey, let's start investing into them now, then we can be making some shifts and some adjustments. So we're not saying don't buy and hold. We're not saying that we can't have the diversification. But what I am saying here is that there are some changes that can be made that actually will better you over the long run. And if we make those changes based upon the signal and based upon the strength of the trends that we are seeing, so that strategic moves that we can be making, coming back to the lead stages that we're in, all of those put together, well, that actually makes it so that you can have the better opportunities to, first of all, grow, but then secondly, protect in some of the bad times. And overall, you don't need to have 20, 30, 40% drawdowns when we're talking about the fact that we need, well, in the case of 20%, we're going to need a lot more just to get back to even. In the case of 30, 40, 50% down, it's going to take a long time just to get back to where we were, let alone start to grow. And if we start panicking, first of all, and start moving to cash right away when that may not be the best opportunity and the best use of your money, well, then that obviously takes you out of the running. So we may not necessarily want to do that. But there's going to be a lot of other opportunities that are out there based upon the trends that we're seeing that you're actually able to be invested into that will continue to either protect or grow your accounts when we need them to. So that's where we can actually be coming back and forth between the two different areas. We can still use the same strategies that you know of, but now it's just taking the extra amount of just a couple seconds of your time or your financial advisor's time just to see if the signal says, should we be invested into them or not? And if we shouldn't be invested into them, well, then let's take the opportunity to move into something else that's going to be a good fit for you. So those are some of the strategies that you can actually be going through. And like I said, whether it's in good times or bad times, knowing those trends, knowing those signals is very helpful. Now, what happens if you are down a lot? So let's say you are down 25, 30% with your money, and you're just wanting to try to get back to where you were. Well, what I'm going to tell you is no different. We start taking a look at where you're at today, start to take a look at what lead stage we're going into, so that the economic stages, the inflation stages, and that's easy actually to model. Those are things that you can easily model yourself. And then we take a look at, well, the trends that are already in place, what is doing well. And there's been an adage out there that says there's always a bull market somewhere. And that actually is pretty true when you think about it. And a bull market is something where an investment is going up. Now, in bad times, when it seemingly seems that every single investment is going down, take a look, because there actually may be some that are going up. And those investments may be something that you've never thought of before. So whether it's commodities that you've never thought about before, whether it's a certain type of real estate with real estate investment trusts, and these are all things that you can be looking at. And there may be an actual strategy that's working today that you were not even aware of. Now that is something that we can start to look into, that we can start making some small adjustments and moving into. And if it works for 3 months, if it works for 6 months, great. But what that means is, yes, we may need to make small adjustments along the way, but that also means that we most likely won't suffer all of the types of losses that many other people are going through when we have 20%, 30% down moves. And like I said, if you're down that much, making those small adjustments today is actually going to set yourself up for growth coming back. So that's exactly what we want. We don't want to stay down 20%, 30%. We don't want to move completely out of the stock market, because what happens if we have a good rebound? But we know that there are going to be some investments that will work. It's just a matter of finding those investments and just a matter of figuring out if that's going to be a great place for you to be in the short term or the long term. So it may not be a buy and hold for the entirety of your investing career, but it's going to be a buy and hold for the period of time that you need it most. There were a lot of strategies that I put into place here with respect to how to use your investments wisely and to make sure that you don't have the drawdowns of 20%, 30% that other people may, that you can be talking to your financial advisor correctly. So all of these strategies are really important that you can be modeling yourself. Now, as you want someone to help you, as you want a second opinion on the investments and what you're doing, and looking at those different stages, so whether it's the lead stages, the signals, the trend stages, all of those things that we had talked about in this video, you can actually be meeting with us and starting to go through what I call a second opinion, just to look at where you're at today, where you want to go in the future. And starting with those investments, some small adjustments that may need to be made to better where you're going to be in that time. Now again, that's not a guarantee that you will be better off, but what it is saying is that when we talk about the mathematical probability, we're putting ourselves into a higher likelihood that we can actually be growing the investments based upon math. That's what we want to be doing ultimately, to make sure that you are taken care of in whatever endeavor, whether it's your family, whether it is with your future travel plans, any of those things, that you can be better off tomorrow than where you're at today. Now, if you want to have a second opinion on your own personal investments, click the link below and we'd be happy to set up just a 15-minute introductory call. Now with that, there's going to be plenty of other videos that you can be watching, and we have hand selected some videos for you that is going to help you with some of those investments, including the process you can be going down, and just by clicking the video right here.